Great. What I want to show you now is what it looks like once you log into a trading platform. This is typically what you will see. Of course, all trading platforms will differ, and separately I'll give you a list of the trading platforms I like so that you can try those out. But typically this is what a screen will look like. And after you log in, you will see price charts for various currencies. For instance, the currencies that you can see on screen here are euro, dollar, GBP, USD, and so on. You'll also see timeframes. That's 4-hour chart, 4-hour, and so on. And were you to click these timelines up here, you could change the view on any of those. Were you to pick here, you could change what's displayed, for instance. So this is what we see after we log in. How do we go from there to placing a trade and having an idea of when to buy and when to sell? I want to give you in this lecture a quick summary of exactly how to do all of those things. It's almost an overview of what this whole course is all about. So the first thing you'll do is pick currencies you like to trade. For me, GBP USD. So sterling dollar is a particular favorite. And you'll usually see on these trading platforms a buy and sell ticket. You can see there we're buying at 56, selling at 54. Obviously, we're not making a profit if we're buying at 56, selling at 54. That 2-pip spread, 2-point spread, is what the broker, of course, makes. So we need the price to move in our direction, so we buy low, sell high, or we sell high and buy low. Okay, and by clicking on either of those buttons, depending on whether we think the price will rise or fall. So the next step is we pick the time frame. Like I said, this is an overview of everything. I'll be going into far more detail in the subsequent lectures. This is just an overview. Pick the time frame. You might click 1 hour. Now, if you click 5, 15, or 30 minute, that's really for a day trader or somebody who's trading after work because it's quite active. That means each one of these bars will be either 5 minutes or 15 minutes or 30 minutes, depending on which one of these indicators, which one of these buttons you press. So that'll be for somebody who's watching the screen constantly, getting trading signals all the time. Were you to click 1 hour or 4 hours, that's really for somebody who's occasionally going to be watching the markets. Maybe they've got a day job, they place a trade, then they go off, and then they make a trade later on in the day. One day you get too few signals if you click one day, so I don't particularly recommend doing that. Okay, so for me, if I'm going to be looking at the screen constantly and deciding when to buy and sell, and I'll come to in a second how we decide when to buy and sell, I'll go by the 5, 15, or 30 minute. Now, the next step we want to do is work out when do we buy and sell? How do we know when to click those buy and sell buttons? And one thing I do, and again, this is just an overview, is I use something called a momentum indicator called the MACD. Far more detail in other lectures on that. And I'll show you how I use it to decide when to buy and sell. Well, first of all, we need to know how do I get that on screen. The way I get it on screen is I'd click on Insert, Indicators, Oscillators, and then MACD. When I do that, hey presto, it appears on screen. This is my trading strategy, just one of the several strategies that I have. And as I said, it's just a quick rough and ready update overview so you can understand how easy it is what we traders do. I'll click on M15, which is a 15-minute bar. So each one of these bars represents 15 minutes. I'll look to see, I'm looking at the red dotted line here. I'll look to see, is that rising? If it's rising, it means that the price momentum is upwards and the price is likely to rise. If it's falling, it means the price is likely to fall. Now, if here I see it rising slightly, then I'll be getting ready to click on buy. But wait, it's not that simple. Not that simple. It's what the textbooks tell you. We want to go beyond the textbooks. We want to be more advanced and sophisticated than that. So what do I do next? I then click on M5. Look at the 5-minute bars. Okay, and I see, oh, the MACD is rising as well. Now, it's not ideal because it's not rising strongly. I'm looking at the red dotted line, not rising strongly. And remember, this is a momentum indicator. It stands for moving average convergence divergence. A lot of mathematics, but basically what it's telling you is whether there is momentum in the price, whether it's likely to follow through and go up. Not a perfect indicator, not 100% accurate, but better than a coin toss at 5 times out of 10 being right. So therefore, for, maybe it's right 6, 7, 8 times out of 10. That puts the odds in your favor. But I'll also give you an overview of how it is we professional traders make money just by being right 6, 7, or 8 times out of 10. So I look at this on the M5. Now, why am I looking at the M5 if I just looked at the 15-minute? Well, you see, the 15-minute is slightly longer term, isn't it, than 5-minute? And if the 15-minute longer term money is pushing the market up and providing momentum upwards, then on the 5-minute, I should expect that to follow through and that to happen as well. So I look at the 5-minute bars, and I see that the MACD, okay, it's going sideways. It's not coming up strongly from low down here and going all the way up there. It's sort of flat to rising. But because on the 15-minute it was rising, I look at that and think, okay, let's see, I might want to buy this. And I look to buy by clicking on there at 55. How much am I buying? Well, I'm buying one lot because that's what it says there. Now, don't forget, with lots, I explain how they work in different lectures, but I'm just giving you a very quick, rough and ready guide here. I set up my screens so they look like this. You saw that earlier we can have 4 screens on there. So I've got the M5, the M15, the M30, and the 1 hour. What I actually look to do is to see, is the MACD rising on all of these? Now, you notice it's sort of rising on the M5 and the M15, but it's not rising on the M30 and the 1 hour. So 2 out of 4, not ideal. I actually want to get 3 out of 4 of these before I go long and buy. But let's say, for argument's sake, we did click on buy and we went in. This is how I set up my screens. Now, if I can't put all 4 screens onto one desktop, because I might be on my smartphone where I can also download platforms, most brokers will allow you to trade off an iPad or a smartphone, then I'll just click the buttons and look between them at sterling dollar. So you see how I did the arrangements, which is pretty easy to do on a platform. Once you get used to it, you just click on the windows and the charts and the tools, which will allow you then to set it up just like this and save the template. All of that's pretty straightforward. But there's a quick rough and ready strategy even. So what are the things that we private investors, we professional traders do, which are way beyond what private investors do? Well, I won't just look to buy in to a trade like that. I'll also look, as soon as the trade goes into profit, to add to those profits by adding new positions. I'll also cut my losses very quickly. As soon as the M15 MACD falls, I'm out of there. I don't want to hang around. Okay, that's what professionals do. Private investors don't do that. Private investors don't add to their profitable positions. What I'll also do is, and you'll learn about this later on, is I'll place limit orders to take profits if I can't be in front of the screen. So I'll place it at a higher level. So if I'm not watching, at least it'll take the profits. I'll place a stop loss if I can't be in front of the screen as well, just in case it falls too far from my entry level. My losses won't be indefinite. I'll also make sure that the take profit level is higher than the stop loss level from where I entered by a ratio of at least 1-to-1, but preferably even 2-to-1. Okay, I'd go far more detail into all of this in the other lectures, but I just want to, as I say, give you an overview of how quickly and how easily we trade. Let me give you another quick strategy then. Same screen, sterling dollar, M5, 5-minute bars. Each one of those bars is 5 minutes. This is the breakout strategy. At point number 1 is the entry. At point number 2 is my take profit level, which is at a likely resistance, or where I think the move might falter if it goes above point 1. So that's my take profit. Why is that a likely resistance? Well, you saw here the prices bounced off this level. That is therefore a support, but then the support got broken. When supports get broken, they become resistances. So this line too is probably going to be a likely resistance. Okay, and point 3 is a stop loss, because I think if the market did go above 1 and then went back below to 3, then I'm obviously wrong in my analysis and we get out. We don't want indefinite losses. And the distance from 1 to 2, which is my reward, from 1 to 2, is greater than the distance from 1 to 3, which is my loss. So my reward is greater than my risk. My reward is greater than my risk. And if it moves in my favor, I add to the profits as well by adding new positions. What does a professional trader do that a private investor doesn't? He has a reward level greater than his risk level, and he adds to winning positions, and he sets a stop loss and gets out quickly. Those are critical factors of what we do. How do I know then when to exit? Well, on a breakout, and assume that this is the breakout level, because you saw that the price hit that resistance, hit it again, then eventually broke out. What do? Well, this is how we maximize profits. We add to profits as the price rises strongly in our favor. You see it's moving up in just those 5-minute bars. This is, by the way, 15-minute bars. 15-minute bars. It's moving up in those 15-minute bars. As it moves up quickly and sharply, we add to those positions and we should get more profits. We see it moving up with speed because in only just 15 minutes, it moves up such a large distance. We click, add to those positions. But how do we know when to exit then? Well, we know when to exit when the rise is no longer smooth. What does that mean? When the price does not move higher than it did in the previous period. You notice here that the price didn't move higher than in the previous period. So then we start getting worried. We don't necessarily exit all our positions, but we might start exiting 1 or 2 of the additional positions. If we had 5 positions on, we might exit 1 or 2 of those. And the price moves lower than in the previous period is also a warning sign. So 2 warning signs. Price moves lower than in the previous period. See, that low is lower than the previous period's low. And it doesn't move higher than in the previous period. Those are reasons to get out of there, to get out of those trades. That's just one way to exit. The other way to exit, I told you, was the MACD. The other way to exit, I'll show you in other lectures. How we add to profits is critical. I don't add to profits by saying, oh, if it moves 1 pip here. It's not a precise science. It's an art. I see it moving quickly, and therefore I look to enter into those positions because that grabs me a lot of profits. These are all the kind of critical things you'll learn, and I just showed you how easy it is to place a trade, how you set up the screen, how you buy, how you sell, and practice on a demo account teaches you so much so quickly. I'm going to show you more strategies as we go ahead. This is just a very quick, rapid overview that I gave just now as a bit of a taster of what's going to come in the step-by-step guide.